If it works, betting against a stock can mean a pretty profit for a savvy investor. Of course, the same can't be said about the company whose stock is being shorted. And as Karina Huber reports, the practice can lead to dangerous consequences for a stock market and its investors.
GameStop, the video gaming retailer, was one of the most heavily shorted stocks on the S&P 500 last year. At one point, more than 50% of its outstanding shares had been sold short, which means a majority were betting the stock price would fall.
People feel like gaming is moving online ultimately, and they've got, thousands of stores that they're ultimately going to have to close because it's moving from physical to digital.
Analyst Joe Feldman says despite the heavy short selling, don't write them off entirely.
There's a healthy skepticism here, and I get it. I totally understand it. But I think it's too easy to say that GameStop is going to be Barnes & Noble or Radio Shack or go that way.
Where the stock is headed is anyone's guess. Investing is often speculative. Some have accused short sellers of being destructive because their bets can sometimes drive down a company's stock even when it has a good product or service. But experts like NYU Stern professor Stephen Figluski says short sellers also create accountability and a healthy counterbalance to an industry that tends to be bullish.
There is this natural bias in the markets to buy stock, to own stock, to want stock prices to go up. And nobody likes receiving bad information, even if it's true.
Experts say shorting is risky. You can lose your shirt, so it's only for the experienced investor. But they advise investors to pay attention to the naysayers. What they say may not come to fruition, but it is a signal to take a closer look at what's going on. Karina Huber, CCTV, New York.